It is Saturday, June 16th, 2018. It is 9-something p.m. PST. And so, of course, you know what time it is. It's way past time for some fucking coin metal. That's what time it is. Unfortunately, I was not here yesterday, but if it is any comfort to anybody, and I know some of you guys actually listen to the show specifically to hear about jiu-jitsu, I finally did it. I am now a blue belt at Northwest Martial Arts. I finally ascended past the white belt level of drudgery, and I got to tell you, I really feel like the last month or so have been probably the most cohesive at a transition that I've faced, and I don't understand why, really. I mean, I've got to think at least partially it has to do with my injury of all things, because honestly, the injury itself forced me to adapt my game to where I wasn't just crushing, and trying to power my way through everything. And it really forced me to reevaluate the situation, let my partner move, let them get ahead of themselves, or at least give me an opportunity to get them ahead of themselves. And so last night, they didn't just give us our belts right off the bat and our tags. It was supposed to be a open mat, or at least that's what it was advertised as. But instead, we did have one of the instructors leading us through an entire class of 4-minute rounds. And we would do a 4-minute round, and then we would walk around the mat a couple times, and then we would do another 4-minute round, walk around the mat a few times. I did 3. After the second one, the guy that I was facing, he was very, very good. And I did end up pushing my arm a little bit farther than I wanted to, and it was definitely complaining to me. So I let up, and I bowed out of I think all told there was like 7 rounds, and the way we were doing it is 2 minutes with one person in guard and the other person having them in their guard, and then switching top and bottom for the last 2 minutes. And I really enjoyed it, to the part that I'd actually participated in. But like I said, my arm was kind of bugging me by the third one, so I bowed out for a couple. But I did come back for the last one before we closed out for the evening. And the gentleman that I faced was very, very good. Most certainly did earn his blue belt, and that was Nathan. And I got to tell you, that guy, the last time that I rolled with him, he was just so relaxed, and like so attuned to what I was doing, and it was really interesting to see that kind of transition with him, because, not a month ago, he was very, very rigid and very snappy and trying to impose his will kind of thing, and it really felt like this last time, like it's like, okay, you're moving that way, okay, I'll move that way with you, and then I'm going to get you in this. And, for his size, he's very, very strong, he's very athletic, and he's very fleet. I can imagine against a faster player that he would be able to hold his own quite easily. But yeah, it was really impressive to see that kind of progression in him. And of course, my other teammates. We weren't the only two to get our belts. There was a progression to a brown belt by Mr. Paul, and he's a guy that I've rolled with him a few times, and he's very, very, very composed, highly technical, and most certainly deserving of his belt. And congratulations to everybody else who did get their belts and did get their stripes. I don't want to leave anybody out. Although I will not mention you by name, only because of your own privacy. I leave that to you to disclose to others. But congratulations to everybody who did get their promotions yesterday at Northwest Martial Arts. And so, as far as what we're going to talk about today, I had this PDF open, and it's called "Is Bitcoin Really Untethered?" And it's obscenely long. It's 66 pages. I'm hoping some of it's going to be diagrams and big fonts and stuff like that. But I think this is something that we should address because there have been multiple accusations in the past concerning Tether and its ultimate effect on the price of Bitcoin. Personally, I think the latest ascension of Bitcoin's price, it's not so much that Tether had anything to do with it. I mean, don't get me wrong. On the exchanges, I'm sure there was plenty of fuckery afoot. Don't get me wrong. But that's the place where it would be, you know. Where I think the real price ascension, what really caused it was the increase in demand for use of Bitcoin. And I know that's something that's, people don't even address that as a possibility, and I don't understand why, because if you look at the mempool, the chart for the mempool, you see this mountain of fucking transactions stuck in the mempool. It was like 140 megabytes worth of transactions. Now, Bitcoin processes 1 megabyte worth of transactions, or roughly 1.8 megabytes worth of transactions, going by block height, or block weight, rather than not height. Anyway, normally we would be increasing the block size and addressing that, but for the last couple of years, there have been people that have been wanting to get us to use Bitcoin off-chain. And personally, I think this is a route of taking Bitcoin right into the same regulatory apparatus that Visa and other legacy payment processors currently have to do. Now, it's obvious why they would want that. I mean, because they have a monopoly, or they had a monopoly for a very long time, and then all of a sudden here comes Bitcoin and it challenges that. Well, there's a reason why it's here. It's because they weren't doing a very good job at it, They were abusing the market position that they had, and so we did respond, and here's Bitcoin. But just the same, they want their monopoly back. And so it's all about making Bitcoin operate like they operate, and then you have to be licensed the same way that they have to be licensed just to participate in it. But now, with regard to this price spike, again, you look at that mempool, 140 megabytes worth of transactions being held up. That put a hell of a lot of demand on Bitcoin. Now, how it was purchased, I don't know, but they were actually live transactions happening on the network. They could have been being bought with Tether, I don't know. But I think that because they were actually happening on the network, chances are that they were regular transactions by people like you and me trying to move funds either into or out of exchanges, or onto wallets or off of wallets, or exchanging them for goods and services, so on and so forth, caused the price to just jump through the roof because it was suddenly, desirable to do, to move your money around with Bitcoin. And then it became too terribly expensive, and people started using other mediums of exchange. And that's the position that we're in now, where I think that the latest dip that we saw with regard to Bitcoin was because, again, the mempool was getting clogged up with transactions. There, according to one of the charts I was looking at, there were 48 megabytes worth of transactions being held up. Now, Bitcoin only processes 1.8 megabytes of that every 10 minutes. So there was a period where the network was catching up. These are the kinds of things that will inhibit the adoption of Bitcoin. Now, I don't think it's going to inhibit adoption of cryptocurrencies, though, because the utility of cryptocurrencies still exists. And so I think in the longer term, what we are going to see is more migration to altcoins. I really think that 2018, 2019, we're going to stop focusing so much on Bitcoin and start looking to altcoins to solve these issues, because Bitcoin being stuck at 1 megabyte is not doing anybody any good. I mean, they got that stupid whiteboard up where you can draw all over it and whatnot and spend Satoshis that way. Big whoop-de-doo. You know what? I could do that with Paint, and I can do it for free, and then I can post it on the internet and say that, oh, I paid 1 Satoshi for this. I'm not saying that that's what's happening. What I am saying is that it's a waste of fucking technology. You're talking about an international payment system, and we're drawing dick pictures on a fucking graffiti wall with it. Give me a fucking break. I had to hydrate a little bit. Anyway, we are going to go ahead and throw down into music to begin with, but then we're going to dive into this PDF, and I think if we just plow through it, we might actually be able to make it through with the time remaining, and I might actually just run this all the way until 12, because I mean, even then you're not getting a full legit 3 hours of me, but most of today is going to be me reading this thing. So let's go ahead and throw down into some music, and I got fucking Root Down by Beastie Boys going. It's pretty tasty. Let's go ahead and throw that down. I hardly ever play Beastie Boys on here. Root Down by Beastie Boys here on Coin Metal. And that was Sepultura with Dead Embryonic Cells. Gotta love that album, man. Anyway, let's get on with this thing, because it's long. Here it is. It's a PDF, and I guess I'll post this thing somewhere. Maybe. I don't know. I possibly sometime in the future. Just not right this moment. Is Bitcoin really untethered? By John M. Griffin and Eamon Shams. June 13th, 2018. Abstract. This paper investigates whether Tether, a digital currency pegged to US dollars, influences Bitcoin and other cryptocurrency prices during the recent boom. Using algorithms to analyze the blockchain data, we find that purchases with Tether are timed following market downturns and result in sizable increases in Bitcoin prices. Less than 1% of hours with such heavy Tether transactions are associated with 50% of the meteoric rise in Bitcoin and 64% of other top cryptocurrencies. The flow clusters below round prices induces asymmetric autocorrelations in Bitcoin and suggests incomplete Tether backing before month ends. These patterns cannot be explained by investor demand proxies, but are most consistent with the supply-based hypothesis, where Tether is used to provide price support and manipulate cryptocurrency prices. Now, let's see here. Continuing on. Innovation, excessive speculation, and dubious behavior are often closely linked. Periods of extreme rapid price increases, followed by implosion, commonly known as bubbles, are often associated with legitimate inventions, technologies, or opportunities. However, they can be carried to excess. Financial bubbles often coincide with the belief that a rapid gain can be obtained by simply selling the asset to another investor with a stronger belief in the underlying business fundamentals. Perhaps because of the focus on speculative activity rather than verifiable fundamentals, bubbles have historically been associated with various forms of fraud. For example, the Mississippi Bubble of 1719 to 1720, like the 1719 to 1720 South Sea Bubble, experienced inflated valuations around subsequent issuances and leading to margin lending on the securities themselves. Dale, 2004. The company also engaged in false marketing about the potential in its income-generating assets, price support by the stock itself, and paper money that was not fully backed by gold as claimed. As we will briefly discuss in the next section, famous bubbles such as the 1840s railroad bubble, roaring 1920s stock, the dot-com, and 2008 financial crisis contain substantial evidence of misinformation, false accounting, price manipulation, collusion, and fraud, often in sophisticated forms. Cryptocurrencies, which have grown from nearly nothing to over $300 billion in market capitalization in a few years, fit the historic narrative of previous bubbles quite well. There is an innovative technology with extreme speculation surrounding it. To many, Bitcoin and other cryptocurrencies offer the promise of a better financial system with anonymous transactions that are free from banks and government intervention. The conception of Bitcoin corresponds to the middle of the 2008-2009 financial crisis, a time of growing disdain for governmental intervention and distrust for major banks. Well earned, by the way. The promise of a decentralized ledger with independently verifiable transactions has enormous appeal, especially in an age when centralized clearing is subject to concerns of both external hacking and internal manipulation. Nevertheless, the vast majority of cryptocurrency transactions occur on centralized exchanges. These exchanges largely operate outside of the purview of financial regulators and offer varying levels of limited transparency. Additionally, Bitcoin and other cryptocurrencies often trade against digital currencies, even further relaxing the necessity for an exchange to establish a legitimate fiat banking relationship. Trading on unregulated exchanges and specifically on cross-digital currency exchanges could leave cryptocurrencies vulnerable to gaming and manipulation. Our study examines the interaction between the largest cryptocurrency, Bitcoin, and other major cryptocurrencies, and Tether, a cryptocurrency that accounts for more transaction volume than US dollars. Tether is a cryptocurrency purportedly backed by US dollar reserves and allows for dollar-like transactions without a banking connection, which many crypto exchanges have difficulty obtaining or keeping. Although some of the blogosphere and press have expressed skepticism regarding the US dollar reserves backing Tether, the cryptocurrency exchanges have largely rejected such concerns and widely use Tether in transactions. In this paper, to shed light on the driving forces behind the recent boom of cryptocurrency markets, we focus on variants of two main alternative hypotheses for Tether. Whether Tether is pulled, demand-driven, or pushed, supply-driven. First, if Tether is pulled or demanded by investors who own fiat currency, the issuance of Tether facilitates the demand of these investors who value the flexibility of a digital currency and yet the stability of the dollar, quote, peg. The demand for Tether could also arise because of its practicality for engaging in cross-exchange pricing arbitrage. Alternatively, if Tether is pushed on market participants, Bitfinex supplies Tether regardless of the demand from investors with fiat currency to purchase Bitcoin and other cryptocurrencies. The acquired Bitcoins can then gradually be converted into dollars. In this setting, the Tether creators have several potential motives. First, if the Tether founders, like most early cryptocurrency adopters and exchanges, are long on Bitcoin, they have a large incentive to create an artificial demand for Bitcoin and other cryptocurrencies by, quote, printing Tether. Similar to the inflationary effect of printing additional money, this can push cryptocurrency prices up. Second, the coordinated supply of Tether creates an opportunity to manipulate cryptocurrencies. When the prices are falling, like the Tether creators can convert their Tether into Bitcoin in a way that pushes Bitcoin up, and then sell some Bitcoin back into dollars to replenish their Tether reserves as Bitcoin price rises. Finally, if cryptocurrency prices crash, Tether creators essentially have a put option to default on redeeming Tether, or to potentially experience a, quote, hack, where Tether or related dollars disappear. Both the pushed and pulled alternatives have different testable implications for flows and cryptocurrency returns that we can take to the powerful blockchain data. We begin our exercise by collecting and analyzing both Tether and Bitcoin blockchain data through a series of algorithms we implement to reduce the complexity of analyzing the blockchain. In particular, because of the semi-transparent nature of the transaction history recorded on the blockchain, we are able to use variants of methods developed in computer science. To cluster groups of related Bitcoin wallets. Large nodes are then labeled through identifying certain member wallets inside each group and tracking the flow of coins between major players in the market. For example, through this methodology for the Bitcoin blockchain, we grouped over 680,000 wallet addresses as Bitfinex, 950,000 addresses as Poloniex, and 1.4 million addresses as Bittrex. Figure 1 describes how Tether moves along major market participants on the Tether blockchain. The size of the nodes is proportional to the sum of coin inflow and outflow to each node. The thickness of the lines is proportional to the size of the flows, and all flow movements are clockwise. Tether is created, moved to Bitfinex, and then slowly moved out to other crypto exchanges, mainly Poloniex and Bittrex. Interestingly, no Tether returns to the Tether issuer to be redeemed, and the major exchange where Tether can be exchanged for US dollars, Kraken, accounts for only a small portion of transactions. Tether also allows flow out to other exchanges and entities and becomes more widespread over time as a medium of exchange. A similar analysis of the flow of coins on the much larger Bitcoin blockchain shows that three main Tether exchanges for most of 2017, Bitfinex, Poloniex, and Bittrex, also facilitate considerable cross-exchange Bitcoin flows among themselves. Additionally, we find that the cross-exchange currency flows are closely matched on the Tether and Bitcoin blockchains. This independently verifies our algorithm for categorizing the exchange identities, and in addition, shows that wallets associated with Bitfinex send Tether to Poloniex and Bittrex in exchange for Bitcoin. We then examine the flows of coins identified above to understand whether Tether is pushed or pulled, and examine the effect of Tether, if any, on Bitcoin prices. First, following periods of negative Bitcoin return, Tether flows to other exchanges are used to purchase Bitcoin. Second, these flows seem to have a strong effect on future Bitcoin prices. They are present only after periods of negative returns and periods following the printing of Tether, that is, when there is likely an oversupply of Tether in the system. A placebo test finds no evidence of Bitcoin price movements following large flows of Bitcoin from Poloniex and Bittrex to major exchanges other than Bitfinex. This phenomenon strongly suggests that the price effect is driven by Tether issuances. To illustrate the potential magnitude and predictive effect of Tether issuances on Bitcoin prices, we focus on the hours with the largest lagged combined Bitcoin and Tether flows on the two blockchains. These 87 hours have large negative returns before the flows, but are followed by large return reversals. These 87 events account for less than 1% of our time series over the period from the beginning of March 2017 to the end of March 2018, yet are associated with 50% of Bitcoin's compounded return and 64% of the returns on 6 other large cryptocurrencies: Dash, Ethereum Classic, Ethereum, Litecoin, Monero, and Zcash. A bootstrap analysis with 10,000 simulations demonstrates that this behavior never occurs randomly. Consistent with Tether being used to buy Bitcoin when the prices drop, we find a statistically and economically strong reversal in Bitcoin prices, but only following negative returns. The Bitcoin reversal did not exist before Tether was prevalent in the market and disappears during the period when Tether stops being printed. The results are consistent with the Tether issuers pushing out Tether to stabilize the price of Bitcoin, but we investigate those issues further. Investors hoping to stabilize and drive up the price might concentrate on certain price thresholds as an anchor or price floor. This follows the idea that if investors can demonstrate a price floor, then they can induce other traders to purchase. Interestingly, Bitcoin purchases by Bitfinex strongly increase just below multiples of 500. This pattern is only present in periods following the printing of Tether and not observed by other exchanges. To address causality, we use discontinuity in Tether flow at the round threshold cutoffs as an instrument to measure the effect of Tether on Bitcoin prices. The instrumental regression results are even stronger, indicating that Tether flows are causing the positive return. If Tether is pushed out to other crypto exchanges rather than demanded by investors with dollars in hand, Tether may not be fully backed by dollars when issued. However, if the issuers wish to post monthly bank statements to shore up dollar reserves and appear fully backed, this would necessitate the liquidation of the purchased Bitcoins at the end of the month. Interestingly, we find a significant negative EOM abnormal return of 6% in the months with strong Tether issuance. The EOM Bitcoin returns are highly correlated with the magnitude of Tether issuance, and no abnormal returns are observed in the months when Tether is not issued. Our results are consistent with Tether being pushed out onto the market and not primarily driven by investors' demand. But we nevertheless further examine two direct implications of the pulled hypothesis. In particular, we examine if the flows of Tether bear much relation to a proxy for its demand from investors, the premium for Tether relative to the US dollar exchange rate. We find little evidence to support this hypothesis. Another related alternative is that the cross-exchange arbitrage to eliminate pricing discrepancies across exchanges is the primary driver of the Tether flow, but this hypothesis is not supported by the data. Although we find a little support for demand-based proxies, we hypothesize that there are some sources for legitimate demand for Tether. However, those are not the ones that dominate the flow patterns observed in the data. Overall, we find that Tether has a significant impact on the cryptocurrency market. Tether seems to be used both to stabilize and manipulate Bitcoin prices. Although cryptocurrencies are relatively new, the trading mechanisms between and across exchanges are quite complex. This complexity can obfuscate the true nature of trading and the influence of cross-trading across cryptocurrencies. Our findings suggest that market surveillance within a proper regulatory framework may be needed for cryptocurrency markets to be legitimate stores of value and reliable medium for financial transactions. Additional research is necessary to further understand these markets. The rest of the paper unfolds as follows. Section 1 provides an overview of historical bubbles, cryptocurrencies, Tether, and the main pushed and pulled hypotheses to be tested. Section 2 describes and summarizes the main data sources, and Section 3 describes how we analyze the blockchain data. Section 4 analyzes the potential influence of Tether on Bitcoin, and Section 5 further tests whether the flows are consistent with pushed or pulled explanations. Section 6 concludes. Number 1, and we're on page 7 out of 66. I think we're cruising along pretty good with this thing. Number 1, overview of bubbles, Bitcoin, Tether, and hypothesis. 1A, speculative bubbles and the prevalence of dubious market activity. Periods of excessive price speculation often share the themes of optimism around a new technology, focusing on selling to others rather than economic fundamentals and questionable activities. The famous South Sea Bubble, 1719 to 1720, is often described as a sophisticated Ponzi scheme where old investors were paid high dividends, not from operations, but from new stock issuances, with the hope of higher prices at future issuances. Let's see. Notes that were also many other similar companies around this time that seem to have been fraudulent. The railroad bubble of the 1840s led to a host of companies who merely sought to procure funds from investors and had no intention of actually building railroads. In the roaring 1920s, investment pools would manipulate a stock price through wash sales, collusion with the stock exchange specialists, and coordinated hype from the commenters to pump a stock at an inflated price to the public. The technology or .com bubble of 1997 to 2000 also contained strong elements of stock promotion through inflated analyst forecasts from affiliated analysts, pushing or laddering prices through implicit agreements to purchase more IPO shares than in the aftermarket, and accounting fraud, the most notable being Enron and WorldCom. One line of thinking is that more fraud exists in the economic booms because individuals monitor their investments relatively less closely. Akerlof and Romer also argue that the deception often has an active role in causing capital misallocation. They describe 4 financial crises in the 1980s: Chilean crisis, savings and loan crisis, Dallas real estate, and the junk bond market crisis, where the behavior of actors involved in, quote, looting an organization played an unintentional role of systematically moving capital into a space where asset prices are distorted. In our analysis of Bitcoin and Tether, we are able to examine if either of these views fits the data. 1B. Brief history of Bitcoin and exchange hacks. On October 31, 2008, the white paper Bitcoin, a peer-to-peer electronic cash system, was released by Satoshi Nakamoto. The paper outlines a digital currency system where transactions are recorded on a chain of linked blocks, hence blockchain, and verified electronically through a decentralized network of users. The decentralized feature avoids the traditional system of government-backed currencies controlled by centralized federal banks and clearinghouses. Actually, they're private banks, but we won't go there. On January 3rd, 2009, the first block was established on the Bitcoin blockchain by Nakamoto. On October 5th, 2009, the new Liberty Standard established the first exchange rates of Bitcoin at $1,309.03 Bitcoin for $1 or 0.00076 cents per Bitcoin. One of the largest Bitcoin exchanges of the time, Mt. Gox Exchange, was established on July 17th of 2010. By April 23rd, 2011, Bitcoin exceeded parity with the US dollar, euro, and British pound, with the market cap passing 10 million US dollars. And by March 28th, 2013, the total Bitcoin market cap passed 1 billion US dollars. Mt. Gox, a leading exchange by 2013, was handling approximately 70% of Bitcoin volume. Declared bankruptcy due to a mysterious, quote, hack of the exchange, which resulted in approximately $450 million worth of Bitcoin missing from investors' accounts. Good reasons have been put forward as to why the hack may have been an inside job. Grendel et al. Argues that fraudulent trading on Mt. Gox Exchange led to a significant spike in Bitcoin prices in late 2013. In the second biggest hack in Bitcoin history, on August 2nd, 2016, the Bitfinex exchange announced that $72 million had been stolen from investor accounts, leading Bitcoin to plummet 20% in value. 1C. Brief Tether history. The objective of Tether is to facilitate transactions between cryptocurrency exchanges with a rate pegged to the US dollar. It allows performing high-speed capital transfers without resorting to slow bank wires. While this could occur with fiat transactions, Tether is advantageous since many crypto exchanges have a hard time securing bank relationships. Tether Limited, the issuer of Tether, claims that Tether platform currencies are 100% backed by actual fiat currency assets in our reserve account. However, Tether itself has created ambiguity around this backing by noting that they are not guaranteed redemption rights. The Bitfinex exchange started in 2012 but experienced rapid growth and now claims that they are the world's largest and most advanced cryptocurrency trading platform. Paradise Paper Leaks in November of 2017 named the Bitfinex exchange officials Philip Porter and Giancarlo Devasini responsible for setting up Tether Holdings Limited in the British Virgin Islands in 2014. Figure 2 Panel A shows the cumulative issuance of Tether denominated in both US dollars and Bitcoin, as well as Bitcoin prices. The first Tether was issued on October 6, 2014, but the market cap was only $25 million as of March 6, 2017. Between March 7, 2017 and January 2018, however, more than $2.2 billion worth of Tether was issued. As of May 25, 2018, Tether is ranked the 14th largest market cap cryptocurrency in the world, with a market cap of around $2.5 billion US dollars. Panel B of Figure 2 shows transactions of major cryptocurrencies in US dollars as compared to Tether, aggregated across all cryptocurrency exchanges available on CoinAPI. Although cryptocurrencies were historically denominated in dollars or yuan, a large share of Bitcoin and many other cryptocurrency transactions are now denominated in Tether. Additionally, even after closely examining Bitfinex's public statements, it is unclear as to whether Bitfinex transactions are denominated in dollars or Tether. Prices quoted on Bitfinex are significantly closer to prices on Tether exchanges than US dollar exchanges. Hence, we term Bitfinex transactions as well as those explicitly denominated in Tether as Tether-related. Those in the blogosphere and the mainstream press began to raise questions regarding Tether in the second half of 2017. On April of 2017, Tether lost its banking relationship with a Taiwanese bank linked to Wells Fargo. Since then, Tether has issued over $2 billion worth of Tether without fully disclosing banking details. However, this could be due to not wanting to subject their bank to public scrutiny and lose their new banking relationship, since many large banks avoid the scrutiny of crypto-related deposits, either because of perceived reputation tainting or due to the burden of needing to comply with anti-money laundering or know-your-customer banking regulations. Additionally, Tether has not disclosed whether it has consistently been employing an external auditor. Bloggers have also conjectured about whether Tether issuances are fueling Bitcoin. One website, tetherreport.com, finds positive return effects after incidences of Tether issuances, and analysis by We finds no price effect at the time of Tether issuances. 1D, Main Hypothesis. This section examines two main alternative pulled versus pushed hypotheses about Tether functions. Number 1, Tether is driven by legitimate demand for a pegged digital currency. Or number 2, Tether is pushed through a supply-driven scheme to make up a currency, convert it into Bitcoin, and then manipulate the price of Bitcoin and other cryptocurrencies. Our first hypothesis is that Tether is driven by the investor demand and is always fully backed by US dollars, as with a full reserve bank. There is an intuitive appeal for investors demanding a currency that can provide a stable store of value, support quick transactions, and potentially allow cryptocurrency exchanges to skirt banking regulations required for deposits. If driven by the investor demand as a medium of exchange, Tether issuance and flow should be sensitive to the demand from the market participants who have dollars or other fiat currencies in hand. This pulled or demand-driven hypothesis comes in two major variants. H1A. Tether should be printed when Tether's premium relative to US dollar increases and not printed at times when it decreases. Tether flows should be strongly related to the changes in Tether USD exchange rate. H1B. The printing of Tether might also be driven by its usefulness as a facilitator of cross-exchange arbitrage to eliminate price discrepancies across cryptocurrency exchanges. For example, Tether outflows from Bitfinex to another exchange should primarily correspond to periods when Bitcoin sells at a premium on Bitfinex relative to that exchange rate. The alternative key hypothesis is that Tether is being printed independently of demand and pushed onto the market. The issuers can print Tether and can convert it into more widely accepted cryptocurrencies such as Bitcoin. In addition to issuance and transaction fees earned from trading in Tether, other possible valuable benefits of such a plan could be as follows. First, like an inflationary effect of printing money, issuing Tether could significantly push cryptocurrency prices up by generating an artificial demand for them. Since most cryptocurrency exchanges and early movers are long in Bitcoin and other cryptocurrencies, they would benefit from such large price appreciation. Second, since Tether issuances are large, If traded strategically, Tether could be used to manipulate the price of Bitcoin. This enables Tether issuers to stabilize and or set regional price floors and push the price of Bitcoin and other cryptocurrencies upward. If Bitcoin prices increase, then the founders can cash out the acquired Bitcoins into dollars, likely at a slower pace and on an opaque channel that has less price impact than their initial buying behavior. If the Tether issuers wish to legitimize Tether and avoid scrutiny, they could convert some of their cryptocurrencies to US dollars and retrospectively provide dollar reserves for Tether. Third, the Tether issuers create a valuable put option in the case of a future crypto market downturn. The founders of Tether have a valuable option to not redeem Tether to dollars and possibly experience an inside quote hack, perhaps similar to the one at Mt. Gox, when Tether and or their associated dollars suddenly disappear. To examine the supply-driven manipulation hypothesis, we examined the following predictions. H2A. If Tether issuers are trying to purchase Bitcoin at low prices and provide stability to the market during the downturn, outflows of Tether and purchases of Bitcoin by Bitfinex should follow periods of negative Bitcoin returns. H2B. If the Tether supply is large, Bitcoin purchases with Tether from Bitfinex could push the Bitcoin and other cryptocurrency prices up. This effect should be more pronounced in periods with large Tether issuances. H2C. Bitcoin returns should show a return reversal for negative returns, especially during times when Tether is actively printed. H2D. Since round number thresholds can be price anchors to set a price floor and are often used as buying signals by investors, Bitcoin purchases using Tether might increase if Tether falls below those salient thresholds. This effect should be more pronounced in periods with large Tether issuances. H2E. If Tether is not fully backed by dollars at the outset and is instead engaged in fractional reserve banking activity, but the issuers want to signal to investors otherwise by releasing EOM accounting statements, then Tether creators must liquidate the Bitcoins into US dollar to demonstrate sufficient reserves. This could create negative returns in Bitcoin at EOM. This effect should be more pronounced in periods with large Tether issuances. In the next section, we discuss the data and details behind testing the developed hypotheses. 2. Data. The price and the blockchain data obtained for this study amount to over 200 gigabytes from more than 10 sources, with Coin API, CoinMarketCap, Blockchain.info, OmniExplorer.info, and CoinDesk as our main sources. The intraday pricing data on major cryptocurrencies are from Coin API. Hourly and 5-minute returns are calculated from the last trade within each minute. Missing prices are carried forward for non-trading periods of up to 5 minutes. Prices are assumed missing if stale for more than 5 minutes. The starting date varies for different currencies. The sample covers 25 months from March 2016 to March 2018, but the main set of tests is implemented after March 2017 when Tether experienced a large issuance. Daily prices of various coins are obtained from CoinMarketCap.com, which calculates the price of each coin by taking the volume-weighted average of prices reported at different exchanges. The daily prices are based on the UTC time, and close and open prices are calculated based on a 24-hour day cycle that ends at midnight UTC. We also use intraday CoinDesk Price Index, which is one of the most tracked price indexes in the cryptocurrency market. CoinDesk calculates a Bitcoin index using prices across major markets. The Bitcoin blockchain data is obtained from blockchain.info and covers a period from Bitcoin initiation in 2009 to March 2018. The blockchain data contain all the history of Bitcoin transactions between Bitcoin wallets and include variables such as wallet IDs of senders and recipients as a string of 34 characters and numbers, the amount of coins transferred, timestamp, transaction ID, and the previous transaction ID where the coin was received by the sender of each transaction. A transaction can have multiple senders and recipients. In fact, it is common to see Bitcoin transactions with hundreds of senders and recipients, making tracking of the coins on the blockchain extremely complex. Tether is issued via the Omni-Layer protocol based on the Bitcoin blockchain, and Tether blockchain data are from OmniExplorer.info from October 2014 to March of 2018. Each transaction of Tether includes the wallet IDs of the sender and the recipient, usually a string of 34 characters and numbers, amount of coins transferred, timestamp, transaction status, type of action, and transaction ID as a 64-character hash string. Wallet identities of major exchanges are manually collected from the Tether rich list on tether.to and at multiple snapshots between January and March of 2018. These exchanges account for a major part of Tether transactions. Flows between two parties on the blockchain are defined as the signal net amount of capital transfer between those entities. Specifically, our tests require the flow of coins between major Tether exchanges Bitfinex, Poloniex, and Bittrex during our sample period. For Bitcoin, we simply aggregate the net amount of coins transferred between these exchanges in each period. And they've got this big ass thing here, math problem, where BTC I shows the amount of coins transferred from a group of wallets I to a group of wallets J between the hours of T1 and T. For Tether to measure the value relative to Bitcoin prices, we accumulate the Bitcoin denominated value of Tether using Bitcoin prices at the time of transaction. Based on the wallets labeled in Figure 1, we define the net flow of Tether as below, and yet another big thing here. Tether exchanges account for a large portion of cryptocurrency's trade volume over our sample period. Table 1, Panel A, shows the total traded volume on major exchanges for major cryptocurrencies in billion US dollars from March 1st, 2017 to March 31st, 2018. Some exchanges, including Gemini and Coinbase, specialize in a limited number of major currencies such as Bitcoin, Ethereum. Others, especially Tether-related exchanges, list a large number of coins. Bitfinex has the largest volume both from Bitcoin and across all major cryptocurrencies. Other Tether exchanges also play an important role among the top 10 exchanges in terms of aggregate volume. Panel B of Table 1 shows the cross-sectional correlation of cryptocurrency's daily returns. Not surprisingly, the daily returns are positively correlated across all the coins, but there seems to be a good variation across different cryptocurrencies. For example, Bitcoin's correlation with Ethereum, Ripple, and Litecoin are 0.44, 0.20, and 0.45 respectively. This highlights a reasonable degree of cross-sectional variation in coin returns. Panel C of Table 1 shows an autocorrelation of cryptocurrencies at various frequencies. The autocorrelations are generally negative. For example, a 1% change in the lagged 3-hour Bitcoin prices is followed by 6 basis points reversal in the next 3 hours. At 3-hour intervals, Dashcoin, Ethereum Classic, Ethereum, and Ripple seem to have the highest reversals at 7 basis points. Tracking currency movements. Analyzing Bitcoin blockchain. The Bitcoin blockchain is approximately 170 gigabyte network database that includes more than 360 million wallet addresses and billions of transactions. It is common for each entity to have multiple wallet addresses, and transactions with multiple senders and recipients are frequent. These features contribute to the Bitcoin blockchain's complexity. The complexity of the data can be observed in a 10-minute random sample of the blockchain in 2017, where each node represents a wallet address and each edge shows the flow of coins. To reduce the complexity of the network, we adopt methods from computer science literature and to cluster-related Bitcoin wallets. The idea is when multiple addresses are used as inputs to a single transaction, the entity controlling each of the inputs must have the private signing keys of all the other inputs. Therefore, it is very likely that such addresses are controlled by the same entity. For example, if wallets A and B appear as inputs on a single transaction, and wallets B and C appear as inputs in a different transaction, we group wallets A, B, and C together. We identify connected components between the different groups of wallets across the entire blockchain. For example, consider another group with members X, Y, and Z. If wallets A and X appear as inputs in the same transaction at some point in the blockchain, all the wallets A, B, C, X, Y, Z need to be grouped together. Hence, we find connected components of this same input relation through the entire Bitcoin blockchain and consider each component as a group of wallets controlled by the same entity. To assign identities of grouped wallets to Tether-related exchanges, the addresses of a number of wallets belonging to Tether exchanges are collected from public forums and individual investors who transferred Bitcoin to these exchanges. The clustered group of wallets that contain such addresses are assigned to the identified exchanges. Through this methodology, a group of approximately 950,000 addresses are labeled as Poloniex, and a group of approximately 1.4 million wallets as Bittrex. Due to the limited public information on Bitfinex wallets, the Bitfinex exchange is identified by tracking the flow of coins from Poloniex and Bittrex. A large number of coins from Poloniex and Bittrex are transferred into a group of 680,000 wallets, which then deposits a large balance of coins into a single wallet informally known as the Bitfinex cold wallet. We tentatively labeled this group of 680,000 wallets and then verify in the next section as Bitfinex Exchange. Note that this group of wallets could be associated either with entities closely tied with Bitfinex or with normal traders that have accounts on Bitfinex. Therefore, any inflow or outflow of coins to Bitfinex is captured by our cluster of 680,000 wallets. Lastly, 2 more steps are taken to accurately track the flow of Bitcoins between different entities. First, we exclude change transactions that account for the difference between the total Bitcoin sent and received in one transaction. This change amount arises from the blockchain transaction structure and is returned to the sender. Second, if a transaction has multiple recipients, the flow from sender is allocated proportionally by the number of coins received by each recipient. Figure 3 shows the flows on the Bitcoin blockchain. First, one can see that the Bitcoin blockchain has many more major players than the Tether blockchain, and we did not find identifying information for all the nodes. Second, Bitfinex, Poloniex, and Bittrex are considerable players on the Bitcoin blockchain in terms of the aggregate flow of coins, and there is reasonable flow volume between these exchanges. Third, there are substantial flows between Bitfinex and transitory addresses, which we define as wallets with 4 or less transactions on the blockchain and 0 net balance, and with the Bitfinex cold wallet. 3b. Analyzing the Tether blockchain. As previously described in Figure 1, the graph provides insights into the structure of the Tether network. First, almost all the Tether printed by Tether Limited, the red node in the bottom of the graph, was first moved to Bitfinex and then distributed through the network. Note that there are barely any flows moving back to the initial Tether printing node, consistent with sources stating that this is not viable to move Tether back to Tether Limited to redeem for US dollars. Second, Poloniex and Bitfinex, the largest Tether exchanges for most of 2017, are closely tied to Bitfinex through a large flow of Tether using an intermediary address. Third, Kraken, the small yellow node at the top of the graph, was the only official marketplace for trading US dollars to Tether pair, US dollar Tether pair for the majority of 2017. The magnitude of Tether flow to Kraken is significantly smaller than the other exchanges used to trade Tether for other cryptocurrencies, mainly Bitcoin. Fourth, most of the Tether flows to and from Bitfinex are through Bittrex and Poloniex. There are other flows to nodes that are unidentified. Our calculations showed that approximately 2.99 billion Tether were sent by Bitfinex to Poloniex and Bittrex until February of 2018. The two exchanges sent 1.89 billion back to Bitfinex, making them the net recipient of 1.11 billion Tether from Bitfinex. Throughout the paper, we focus on the timing and the amount of Tether flow from Bitfinex to these two major exchanges, because, as we will show later, this is the primary channel through which Tether is converted to Bitcoin through wallets associated with Bitfinex. Note that since the figure is proportional to the size of the flows, the graph puts substantial emphasis on the end of 2017 and early 2018 as Tether issuance increased rapidly. For this reason, we also display 4 snapshots of the Tether flows through time. For the majority of 2017, Bitfinex, Poloniex, and Bittrex were by far the largest players in the market. Binance, Huobi, OKX, and Kraken gained substantial market share in December of 2017. Verification of the labeling algorithm. In this subsection, we match the flow of Tether with the flow of Bitcoin, as well as reported exchange volume, to simultaneously test number 1, if the correct groups of wallets are identified on the Bitcoin blockchain, and number 2, if Tether from Bitfinex is directly exchanged for Bitcoin. Matching the exact timing of transactions between two blockchains is complicated because transactions done through exchanges or online platforms need not be settled immediately. Damn it, Jim. And might be verified on the blockchain at certain intervals. Moreover, there are different recording delays on Tether and Bitcoin blockchain. This makes examination of exact lead and lag relations between flows complicated. For these reasons, we compare a rolling 3-hour average of our hourly variables in most tests. Figure 4, Panel A, plots the moving average hourly flow of Bitcoin-denominated Tether from Bitfinex to Poloniex, and the flow of Bitcoin back from Poloniex to Bitfinex. The correlation of the two time series is 47%, and the magnitude of the flow is almost the same. This demonstrates, first, that the labeling of Bitcoin wallets through the algorithm described above correctly matches the exchanges of interest with wallet identities on the Tether blockchain obtained from the Tether rich list. If we had incorrectly labeled Bitfinex on the Bitcoin blockchain, then there would be no reason to expect a higher correlation with the flow on the Tether blockchain. Second, the strong correlation between Tether flowing from Bitfinex to Poloniex and Bitcoin flowing back from Poloniex to Bitfinex demonstrates that Tether is directly exchanged for Bitcoin. A similar pattern is shown between Bitfinex and Bittrex, again demonstrating the strong link between Tether and Bitcoin flows through Bitfinex. As a further check on the relation between Tether and exchange transactions, we examine the 3-hour moving average inflow of Tether to Poloniex and Bittrex and the official reported exchange volume. Panel B of Figure 4 shows that the inflow of Tether to Poloniex is highly correlated with the exchange volume for Bitcoin Tether pair. The slope of 3.55 suggests that an inflow of Tether into the exchange is associated with 3.55 times increase in exchange volume. The slope is 1.57% for Bittrex. 3. Timing and characteristics of currency movements. This section examines the timing and characteristics of the flow of coins between Bitfinex and other exchanges. First, we examine the timing of the flow relative to the time that Tether is printed. Throughout the text, printing, issuance, or authorization of Tether refers to the release of coins from the Tether issuer, as shown in the bottom of Figure 1. There are cases where Tether moves quickly in and out of Bitfinex right after printing, but it is also common to see a delay of a few days between Tether printing and the flow of coins from Bitfinex. For example, 50 million Tether was printed on December 20th, 2017 and was subsequently moved to Bitfinex the following day, increasing the Bitfinex net balance of Tether by almost $50 million. However, it took almost 4 days for this amount to be fully moved out of Bitfinex. To better understand the timing of Tether flows, we examine the inflows of Tether to Bitfinex, as well as the outflows of Tether from Bitfinex to the two exchanges in response to the printing of Tether by Tether Limited. Here we estimate a VAR model with 5 lags to examine the impulse response functions, which have been used extensively to examine the flows of capital between countries. The impulse response of Tether flows demonstrates the response of flows to a 1 standard deviation shock to printing of Tether. The regression used to estimate the VAR model is as follows, and we're not going to read it, where y is a 2x1 vector of Tether issuance and Tether flow. AI is a time-variant 2x2 matrix of coefficients. C is a 2x1 vector of constants, and blah, 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 blah. Panel A of Figure 5 indicates the flow of Bitfinex significantly increases after Tether is printed at Tether Limited, but not all the Tether immediately flows into Bitfinex. On average, it can take between 3 and 4 days for most of the Tether to move to Bitfinex. Similarly, panel B shows that the flow of Tether from Bitfinex to other exchanges increases on the day of Tether authorization, though not as much as the inflow to Bitfinex on panel A. Even after 3 days, there are still flows moving out of Bitfinex to other exchanges. In Section 4, we use this delay in the flow of Tether to formally test how Bitcoin prices are influenced when there's an oversupply of Tether in the system. And we're going to take a brief pause here on page 19. I want to go ahead and throw down music for just a moment or two, and then we'll get back to it. Alright, so here we go, a little bit of ministry for you. Let's go, here on Coin Metal. And that was Prong with No Absolutes. And as we continue on, we're only on page 20 of this bad boy, so we are most certainly not going to finish it this evening. And but I mean, I'm going to continue on because I'm desperately curious about this, and I've picked this as a subject matter, and we're going to follow it through to the very end. So here it is, and it says I'm on page 20 of 66. Number 4, are Bitcoin prices related to Tether? Flow of Tether could be systematically related to Bitcoin prices. In this section, we focus on understanding the nature of the relationship between Bitcoin prices and Tether, and also discuss how this relationship is connected to the main hypothesis. 4a. Timing of Tether in response to Bitcoin prices. After printing, Tether is used to purchase Bitcoin on crypto exchanges. We examine if the sensitivity of flow of Tether to Bitcoin returns is symmetric in response to positive and negative shocks. Figure 6 shows that Tether is used to purchase Bitcoin when returns are negative, but we do not find considerable Tether flows following price increases. Specifically, controlling for lagged volatility, Bitfinex wallets send out Tethers, panel A, and purchases Bitcoin, panel B, when the lagged return of Bitcoin is negative. But there is no relationship when the previous Bitcoin return is positive. Consistent with hypothesis H2A, the results are sizable and statistically significant. For a 1% drop in the average lagged return, when the lagged return is negative, 72 more Bitcoins are obtained per hour with a t-statistic of 7.7. However, the relationship is insignificant when the lagged return is positive. The fact that Tether is not being bought back to the same extent following positive returns is suggestive of Tether being used to protect Bitcoin prices during downturns rather than benign market-making activities where Tether would be returned in periods of high Bitcoin returns. 4b. Do flows of Tether generally affect cryptocurrency returns? The previous section established that wallets associated with Bitfinex transfer Tether to other exchanges following periods of negative Bitcoin returns. This has testable implications for Bitcoin returns. It has been shown that supply and demand for stocks does influence prices. For example, Cohen, Dether, and Malloy, 2007. One should expect this effect to be stronger for cryptocurrencies because, first, there is no fundamental cash flows from which prices are derived. Second, the supply of coins is often fixed. In particular, if Tether issuances are sizable, Bitcoin prices should be affected by a movement of Tether into the market. Moreover, as described in H2B, if Tether is being used to protect and push up the market, the effect of Tether transactions on Bitcoin prices should be stronger following negative Bitcoin returns. If a large flow of Tether is required to move prices. Figure 6 shows that such a large flow happens following negative returns. Additionally, if the flow of Tether is supply-driven, then there is an oversupply of Tether in the network. In days following printing of Tether, the price effect of Tether on Bitcoin should be stronger on days after printing. To test this hypothesis, Table 2 estimates a regression of rolling 3-hour average Bitcoin returns on lagged average net flow of Tether from Bitfinex to Poloniex and Bittrex and Bitcoin back to Bitfinex. We use an average 3-hour Bitcoin returns as our dependent variable to capture the full effect of the cross-exchange flow of coins, as the effect might not be incorporated in exchange prices immediately. The standard errors are adjusted for heteroscedasticity, and autocorrection using Nui West procedure with up to 3 lags. Moreover, as shown previously in Figure 4, the magnitude of the flow of coins on the two blockchains matches closely, and the correlation of the two flows is high, but the timing is not perfectly matched. Given that the timing of blockchain transactions is not an exact measure, but a proxy for the actual time of trade, we average the two flows on the two blockchains to reduce the noise of the timing. Column 1 shows that on days right after Tether printing, for a 100 Bitcoin increase in the flow, the 3-hour average future Bitcoin return goes up by 4.37 basis points, controlling for lagged return. Column 2 shows that the effect only exists in days following Tether issuance, and there is no relationship between the flow of Tether and Bitcoin prices on days apart from printing Tether, consistent with the supply-driven hypothesis, H2B. Moreover, columns 3 and 4 show that the effect exists only after a negative shock to Bitcoin prices. Finally, column 5 shows that the effect is even stronger when conditioning on both Tether issuance and a lagged negative return. For a 100 Bitcoin increase in the flow, the average future Bitcoin return goes up by 8.59 basis points. And just excuse me a moment, I'm going to hydrate. A placebo test examining the relationship between the flow of coins between other major US dollar exchanges and Bitcoin prices sheds more light on whether the strategic price movement is specific to Tether exchanges. Panel B of Table 2 estimates a regression similar to Column 5, where the independent variable is the cross-exchange flow of Bitcoin from Poloniex and Bittrex to major exchanges including Bitstamp, BTCC, Kraken, and Gemini identified on the blockchain. The results demonstrate that only the flow to Bitfinex was significantly related to future returns. Moreover, the effect of Bitfinex flow stays similar after controlling for the flow from all other exchanges. Table 3 estimates similar regressions of return on lagged flow for other major cryptocurrencies. The currencies are chosen from a list of high-volume currencies used in Table 1, conditioning on trading on at least one of the Tether-related exchanges as of March 1st, 2017. Panel A shows that there is a significant effect of flow on return in days following Tether issuance for all other major cryptocurrencies. 5 out of 6 currencies show significant effect following a negative return, while only one is significant following a positive return. Finally, the effects are larger across all coins when conditioning on both days after Tether issuance and following a negative return. For equivalent of a 100 Bitcoin increase in the flow, the average future return goes up by 8.78 to 15.66 BP for different coins. Overall, these results show that there is a strong relation between Tether flows and other major cryptocurrency returns. However, they are prone to endogeneity issues that would cause underestimation or overestimation of the effect. We will discuss ways to address these concerns in subsequent sections. 4C, large flows and prices. We now specifically focus on the largest Tether purchases of Bitcoin. In line with the evidence of the purchases following Tether issuances and negative returns, we condition on Tether issuance in the prior 3 days, negative returns in the prior hour, and flows above 200 coins on both the Tether and Bitcoin blockchains in the prior hour. The joint conditioning on both blockchains addresses the noise in the timing of recording on the blockchains and focuses on cases where Tether is being used to purchase Bitcoin. There are 87 hours out of a total of 9,504 hours that meet such criteria. This is less than 1% of the return series over the period. Interestingly, these 87 events have a large relation to returns. The next hour return is a large 64 basis points per hour, significantly different from normal times. Figure 7 implements an event study of Bitcoin and other cryptocurrency prices around these 87 high flow periods. Panel A shows scaled Bitcoin prices. Consistent with conditioning on negative lagged returns. Returns are large and negative between time -1 and 0. Moreover, prices are falling even before time -1, which is not by construction. However, after the large flow, the pattern changes at time 0. The price, scaled to 1 at time 0, consistently increases for the 3 hours after the flow. To examine this effect on other major cryptocurrencies, we examine return patterns around these 87 large Tether-related events for the major coins previously examined in Table 3. Panel B reports sharp positive returns in the 3-hour window following these events for other major cryptocurrencies. 4D. Is the price effect economically important? What is the cumulative economic magnitude of the effects of Tether on Bitcoin and other cryptocurrencies? Such a question is difficult to address. We take a simple approach to partial economic assessment of the effect, but we also note its potential limitations. We compare an actual Bitcoin price series to a series that is extremely similar, except it removes the 87 hours where it seems most likely Tether is used to move Bitcoin. We then compare the actual buy and hold Bitcoin returns to the series with the Tether-related hours removed. From March 1st, 2017 to March 31st, 2018, the actual Bitcoin price rises from around $1,190 to $7,000 for a 488% return. In contrast, the price series without the 87 Tether-related hours ends at around $4,100, a 245% rise. Hence, the hours with the strongest lagged Tether flow, which account for less than 1% of the time series, seem associated with 50% of the Bitcoin buy and hold return over the period. Panel A of Figure 8 compares the compounded return of the 87 returns to a bootstrap distribution of compounded returns over the same period. If instead 87 random hours are excluded, the return excluding the Tether-related events clearly falls to the left of the distribution, and not even 1 in 10,000 observations yields a return as low. The results are also similar if we condition the random selection of the 87 observations on times following Tether issuance and negative returns. Panel B of Figure 8 compares the actual buy and hold return and synthetic return excluding Tether-related hours for other major coins. The percentage of the buy and hold return that are attributable to the Tether-related hours range from 42% for Dash to 82% for Zcash. Ethereum, for example, experienced a 2,400% return during this period, while it would alternatively experience around a 900% return if the Tether-related hours were excluded. Across the 6 other cryptocurrencies, returns of 64%, smaller on average when removing the 87 Tether-related flow hours. Note that this finding has some caveats. First, the effect only considers the hourly periods with extreme flow. Although measuring such findings over other intervals will be less precise and more difficult, the flow effect could push up prices at other times as well. However, the effect does not consider the selling price pressure effect if the Tether issuers later sell the Bitcoin and move the proceedings into dollars. Such a behavior would push Bitcoin prices down. However, it seems feasible that the issuers could sell Bitcoin in a manner with considerably less price impact than their strong buying force, such as selling slowly off the exchange or in a non-transparent trading venue. Overall, although it is difficult to fully assess the exact price impact of Tether on Bitcoin and other cryptocurrencies, these back-of-the-envelope calculations demonstrate that the effect is plausibly large. Let's see where we at. This is 4E, negative serial correlation in Bitcoin prices. The flows of Tether and Bitcoin follow a very specific pattern. Bitfinex buys Bitcoin with Tether when Bitcoin prices drop. If the flow of Tether moves Bitcoin prices, this may cause a price reversal following a negative shock, as described in Hypothesis H2C. We do not expect any effect following positive shocks because Tether flow is only sensitive to return when return is negative. Moreover, we would expect to see a stronger pattern during the time that Tether is actively printed. To test this, we examine the rolling 3-hour average, lagged, and future Bitcoin returns, and test if the future returns are related to the lagged returns. Our previous tests rely on measures of cross-exchange flows, but this test only utilizes returns and does not require flows. Hence, we can expand the period and estimate the test separately for the period between March 2016 and the end of February 2017, when less than 25 million Tether was printed and the flow of Tether was minimal, between March 2017 and March 2018, when more than 100 times as much Tether was printed. Column 1 of Table 4, Panel A, shows that when printing of Tether was virtually zero, future return is not related to the lagged return. However, Column 2 demonstrates that when Tether was printed regularly, a 1% drop in Bitcoin prices was followed by a 14.8 basis points reversal. This is an economically large reversal that is statistically significant. On the other hand, columns 3 and 4 indicate that there is no price reversal after positive lagged returns, regardless of whether Tether is printed or not. These results are consistent with the price impact of Tether used to purchase Bitcoin when prices drop. On January 30th, 2018, it was publicly announced that the U.S. Commodities Futures Trading Commission sent subpoenas to Bitfinex and Tether to investigate claims questioning Tether's validity. Tether issuance was virtually halted in February and March 2018. We use this period of no issuance to test the negative serial correlation disappears when Tether is not printed. Table 4 Panel B shows that the effect was only 0.1 basis points for February and March 2018 and not statistically different from zero. This is much smaller than the return reversal of 22 basis points during December 2017 and January 2018. There is no significant reversal effect after positive price movements in either periods. In conclusion, this section finds considerable evidence that Tether is used to buy Bitcoin following Tether printing and negative returns, and that this phenomenon has a sizable effect on future Bitcoin prices. This effect also holds for other coins and induces an asymmetric negative autocorrelation in Bitcoin returns. 5. Is Tether pushed or pulled? Overall, the results in the previous section are most consistent with the supply-driven manipulation hypothesis through which Tether is being pushed on market participants. We will further examine possible predictions of the supply hypothesis, H2D and H2E, as well as variants of the demand-driven hypothesis that states that Tether is driven by legitimate demand from investors with fiat currencies, H1A, for use in cross-exchange arbitrage, H1B. 5A. Currency flows around round price thresholds. Following Tversky and Kahneman 1974, there is a large literature demonstrating the importance of anchoring for a variety of prices, including stocks. Schiller 2000, page 137, extensively discusses the importance of psychological anchors for stock market prices, indicating one of the anchors as the nearest round number level. Bhattacharya, Holden, and Jacobson 2012 find support for liquidity demanders buying just below round number thresholds in stocks, consistent with investors anchoring value to the round number threshold. Such an anchor could be specifically important for cryptocurrency prices where prices cannot be gauged with a fundamental value. Additionally, cryptocurrency traders likely engage in technical trading in which past price movements generate buy and sell signals. If Tether is used to stabilize market prices during the downturn, one might expect a spike in the flow of Tether around round thresholds, as this might engage other traders in purchasing, as well upon observing a technical support for the threshold. To test this, we first divide hourly prices from CoinDesk by 500, and then put the remainder into bins of $10 width to examine how the flow of Bitcoin for Tether changes near the round thresholds. Figure 9 shows the net average flow of Bitcoin and Tether between Bitfinex and other Tether exchanges as a function of distance to the round thresholds. Panel A shows that on days after Tether issuance, the flow significantly increases just below the round cutoff, but drops right above the cutoff. Panel B of Figure 9 shows that there is not such an effect on days apart from Tether issuance. This relation is despite the fact that the transaction timestamps on Bitcoin and Tether blockchains are a noisy proxy for the actual time of the trades. Otherwise, even a sharper spike could be expected. Table 5, Panel A, formally tests whether Tether flow is different below and above the round price thresholds. The dependent variable is the average net outflow of Tether from an inflow of Bitcoin to Bitfinex. And the independent variable as it is a dummy that takes the value of one if Bitcoin price is in the $50 bandwidth below the round multiples of 500, and 0 if the $50 bandwidth above. Column 1 shows that Bitfinex obtains significantly more Bitcoin per hour when prices are just below those thresholds. More notably, column 2 shows that the results are more pronounced on days after Tether issuance. The flow of coins to Bitfinex increases to more than twice per hour. Column 3 shows that there is no difference in flow below and above the cutoff on days apart from Tether issuance. The result is consistent with the hypothesis that Tether is used strategically to stabilize Bitcoin prices below the round price thresholds. In other words, price suppression. Panel B of Table 5 estimates a regression of average 3-hour future returns on the lagged round threshold dummy. Column 1 shows that on days following Tether issuance, when the price is below the round threshold, the future hourly return is 21 basis points higher on average. Column 2 shows that there is no difference in return below and above the threshold on days apart from Tether issuance. Columns 3 and 4 indicate that the return is 33 basis points higher if the lagged return is negative and insignificant if positive. Note that it is possible that the Bitfinex-related wallets are trading around round number thresholds because they are following behavioral biases. However, their trading in this case would be unlikely to be profitable as documented in the behavioral finance literature. Indeed, Bhattacharya, Holden, and Jacobson 2012 shows that trading just below round number thresholds is extremely costly to market makers. The fact that Bitfinex wallets exhibit such a large coordinated buying behavior provides a coherent explanation as to how prices can be significantly pushed above the thresholds. If other traders see such a large coordinated buying by Bitfinex-related wallets, it is probably optimal for them to join the buying and contribute to the large subsequent price increases. 5b. Do the Tether flows around round thresholds cause price increases? In this section, we use the discontinuity around round number thresholds as an instrument to identify the effect of Tether on Bitcoin prices. We estimate fuzzy regression discontinuity design around the round cutoff. A dummy variable is defined as 1 if Bitcoin price is within the $50 bucket below the round threshold and the time is within the 3-day window after Tether issuance, and 0 if within the $50 bucket above or in days apart from Tether issuance. We use this dummy as an instrument for the Tether-related flows, and our identification assumption is that the only channel the cutoff affects future Bitcoin's returns is through Tether flows. Our identification assumption and exclusion restriction criteria are supported by the fact that, as discussed above, on days apart from Tether issuance, neither the amount of Bitcoin obtained by Bitfinex nor the future Bitcoin return is different below and above the thresholds. A concern is that the observed trading behavior may be due to some general trade clustering on Bitcoin prices and not specific to Bitfinex-related wallets. To examine this possibility, we perform a placebo test using the cross-exchange flow of coins between Poloniex and Bittrex to other major exchanges including Bitstamp, BTCC, Gemini, and Kraken on the Bitcoin blockchain. There is no difference in flows below and above the threshold, neither in days after issuance nor in other days for any of these exchanges. Panel C of Table 5 estimates two-stage least squares regression of 3-hour future Bitcoin returns on the lagged net flow of coins between Tether exchanges, where the flow is instrumented using the cutoff dummy. If the reported walled F statistics show that the first stage regressions are strong, suggesting a valid instrument. If the F statistics range from 7.9 to 22 for different specifications, the second stage regression indicates that for 100 Bitcoin purchased by Bitfinex, the average hourly Bitcoin return in the next 3 hours goes up by 26.5 basis points. The effect is 35 basis points if the sample is limited to days after issuance, 45 basis points if the lagged return is negative, and 49 basis points under both scenarios. This result highlights a very strong effect of Tether on Bitcoin prices, especially on days after Tether issuance and during the market drop. 5C, demand for investors with fiat currency, and 5C1, end-of-month returns. Due to the lack of full transparency regarding audit processes and banking relationships, the blogosphere has questioned whether Tether is always fully backed by dollars. We shed more light on this by borrowing from the intermediary asset pricing literature, specifically Du Tepper and Verdelan. He and Krishnamurthy 2018 that argue that banks' compliance with period-end capital requirements may create a sizable effect on asset prices. To assure traders of the existence of dollar reserves, Tether has issued EOM bank statements from December 2016 to March 2017, audited by a Chinese accounting firm. Tether planned to be audited by Friedman LLP as well, but eventually, where the hell is that? I did something wrong. Don't do that. Way the hell up here. I'm trying to find the exact spot where I left off. To assure traders of the existence of dollar reserves, Tether has issued EOM bank statements from December 2016 to March 2017, audited by a Chinese accounting firm. Tether planned to be audited by Friedman LLP as well, but it eventually canceled the audit due to the excruciatingly detailed procedures. If Tether does not maintain a full reserve daily, but does seek to maintain the reserve at end of month, there could be negative selling pressure on Bitcoin prices to convert Bitcoin to USD reserves before the end of month. We test this by looking at end-of-month daily Bitcoin returns. Additionally, the EOM selling effect should be stronger for months with a higher Tether issuance. The sample includes 25 months from March 2016 to March 2018. Figure 10 divides the monthly issuance of Tether into four quantiles. The blue bars show the raw EOM returns, and the red bars benchmarks the EOM returns by subtracting the average return in 4 days before and 4 days after. There is a clear monotonic relationship between monthly Tether issuance and the EOM negative price pressure. In months with no Tether issuance, there is no EOM effect. However, in months with large Tether issuance, there is a 6% negative benchmark return. Further, in supplemental results, We also estimate a regression of EOM return on monthly Tether issuance and find that it explains 37% of the variations in EOM returns. Table 6 reports formal regression results for the same sample of the EOM returns and 4 days before and 4 days after. Column 1 shows that the EOM return is 2.3% less than in the days around. Columns 2 and 3 indicate that even though there is no effect in months without Tether issuance, in months with Tether issuance, the EOM return is 3.8% less than the days around. The t-statistic is 3.65 despite the relatively small sample. Interestingly, even though returns are noisy and difficult to explain, the simple EOM dummy variable explains nearly 8% of the variation in daily returns. Where the hell did I go? Where the hell is that? Man, I can't use the up and down arrows because it always fucks me up here. Oh, man. Dial me way back. Let's see where I'm at here. Alright. Interestingly, even though the returns are noisy and difficult to explain, the simple EOM dummy variable explains nearly 8% of the variation in daily returns. Finally, column 4 interacts the EOM dummy with the magnitude of the Tether issued in each month. Again, there is no effect in months without Tether issuance. However, for a 1 standard deviation higher Tether issuance, the EOM return is 2.2% more negative. To formally test the monotonicity of the effect, column 5 interacts with the EOM dummy with 4 quantiles of Tether issuance. Relative to months with zero issuance, months with low, medium, and high issuance has a negative EOM return of 1.9%, 3.1%, and 6.1% respectively, all statistically significant. In summary, the strong negative effect on Bitcoin prices in the months of Tether issuance suggests that Tether may induce price effects related to a need to raise month-end reserves. This finding is inconsistent with Tether being just a facilitator technology driven by investor demand, because there is no reason to expect a relation between Tether printing and EOM returns in that case. VC2, or 5C2, sensitivity of the flow to Tether USD rate. Although the above analysis has shown substantial support for a supply-based explanation, we further examined the demand-based explanations for Tether. Imagine investors with billions of dollars who cannot easily move their money into the cryptocurrency world. A cryptocurrency that has a stable value tied to the US dollar can be of benefit to such investors. We examined the demand pressure for this currency by focusing on the Tether USD exchange rate. If the demand for Tether mainly comes from investors holding dollars and seeking to invest in Bitcoin, the greater demand could translate into higher market rate for the Tether USD pair. Kraken was the most active market-based venue for exchanging Tether for the dollar in 2017, although the market volume of the pair was less than 1% of the Bitcoin Tether trade volume. The rate on Kraken often stays close to 1, but has a standard deviation of 2%. If part of the demand for Tether spills over to Kraken, one would expect changes in the tethered US dollar rate to explain the flow of Tether. Panel A of Table 7 estimates a regression of Tether flow on different lags of Tether USD returns as well as the Bitcoin USD returns. We standardize the variables so that the magnitudes of the coefficients are comparable. The results show that Tether flow is highly sensitive to the Bitcoin US dollar pair, as shown previously, but bears little relation to the Tether US dollar pair. In fact, the flow is not sensitive to the first and second lags of Tether to USD. It becomes marginally significant at higher lags, but the magnitude is considerably smaller than the Bitcoin US dollar pair. Panel B shows that the corresponding flow of Bitcoin is highly sensitive to the Bitcoin US dollar rates, but bears no relationship to the Tether US dollar pair. Another argument might be that the price differences between Tether and US dollar exchanges is driving the flow. If Bitcoin prices increase on US dollar exchanges but not on Tether exchanges, an investor may exploit the opportunity by selling Bitcoin on US dollar exchanges, converting the USD to Tether, moving the Tether to Tether exchanges, and purchasing Bitcoin. To test this possibility, two lagged return measures are constructed. First, a 3-hour lagged Bitcoin return averaged across all major exchanges, and second, a 3-hour lagged difference in return between Tether exchanges and US dollar exchanges. The average return captures the effect of Bitcoin price changes, and the difference captures the spread leading to the arbitrage opportunity. When we estimate a regression of Tether and Bitcoin flows on the spread and the average returns, Panel C of Table 7 shows that flows are not sensitive to the spread, but highly sensitive to variations on the average Bitcoin returns. Again, these returns support the spread between Tether and US dollar exchanges is not the driver of the Tether and Bitcoin flow. And 5D, cross-exchange arbitrage among Tether exchanges. Tether may facilitate cross-exchange arbitrage among Tether exchanges. In particular, imagine that Bitcoin prices increase on Bitfinex, but Bitcoin prices on Poloniex have a delay to adjust. Bitfinex exchange or traders using the exchange can respond to the spread by sending Tether to Poloniex and buying undervalued Bitcoins. This cross-exchange arbitrage also necessitates a flow of Tether back to Bitfinex when Bitfinex prices are lower than Poloniex. However, as discussed previously, this reverse flow pattern is not commonly observed. Nevertheless, we formally test whether cross-exchange spread is the main driver of the flow, or it is the average Bitcoin returns across exchanges that drives flow. To test this, two lagged return measures are constructed similar to the previous section. First, a 3-hour lagged return average between Bitfinex and Poloniex, and second, a 3-hour lagged difference in return between the two exchanges. The former captures the effect of average price changes, and the latter captures the arbitrage opportunity. The same measures are constructed for Bittrex exchange, and all the variables are standardized for comparison. Table 8 shows that for one standard deviation increase in the return spread measure, Tether and Bitcoin flow goes up from 0.02 to 0.06 standard deviations, with t-statistics of 1.39 to 3.71. On the other hand, and consistent with the supply-based hypothesis, both Tether and the Bitcoin flows are considerably more sensitive to changes in average Bitcoin returns. One standard deviation drop in the average return increases the flows by 0.08 to 0.11 standard deviations, with statistics from 3.85 to 6.27. These results show that although the flow is used to exploit the cross-exchange arbitrage to some extent, the overall Bitcoin returns across all exchanges are the main driver of the flow. Conclusion. Historical periods of rapid price appreciation are associated with innovation and growth, but also activities that leads to misallocation of capital. The semi-transparent nature of the blockchain provides a unique opportunity to examine the mechanics behind the growth of an asset class during a period of massive speculation. Our analysis centers on examining potential manipulation of Bitcoin and other major cryptocurrencies. We examine whether the growth of a pegged cryptocurrency, Tether, is primarily driven by investor demand or is supplied to investors as a scheme to profit from pushing cryptocurrency prices up. By mapping the blockchains of Bitcoin and Tether, we are able to establish the entities associated with the Bitfinex exchange use Tether to purchase Bitcoin when prices are falling. Such price-supporting activities are successful as Bitcoin prices rise following the periods of intervention. These effects are present only after negative returns and periods following the printing of Tether. Indeed, even less than 1% of extreme exchange of Tether for Bitcoin has substantial aggregate price effects. The buying of Bitcoin with Tether also occurs more aggressively right below salient round number price thresholds, where the price support might be most effective. Negative EOM price pressure on Bitcoin only in months with larger Tether issuance indicates a month-end need for dollar reserves related to Tether. Proxies for Tether demand receive little support in the data, but our results are consistent with the supply-driven manipulation hypothesis. Overall, our findings provide substantial support for the view that price manipulation may be behind substantial distortive effects in cryptocurrencies. These findings suggest that external capital market surveillance and monitoring may be necessary to obtain a market that is truly free. More generally, our findings support the historical narrative that dubious activities are not just a byproduct of price appreciation, but can substantially contribute to price distortions and capital misallocation. Yep, dumb money follows dumb money. No denying that one. That's like an axiom of markets right there. Anyway, it is with that I would like to close this out. I know we didn't get too in-depth with regard to our analysis of their analysis, but it seems like they were actually doing some real work instead of just making a bunch of blind statements. So, of that, we can at least be assured. And so, it is with that I'd like to close out this episode. I'm not entirely certain exactly which song I'm going to play as our last one, but seeing as we're talking about statistics, we'll go with deviance. And it is with that, like I said, I'd like to close out this episode. Thank you very, very much for listening. I certainly do appreciate the support. And we will be back again on Monday at 8 p.m. Pacific Standard Time as normally scheduled. So until then, I want you all to trade safe, do your homework, and watch out for your own bunghole, because somebody's probably going to try and steal it out from under you if you aren't. And it's with that I'd like to close this episode out. Slayer Deviance here on Coin Metal Last Dance. Thanks again for listening, and you all have an excellent weekend.